There is a number on Wall Street, a single, solitary figure that appears everywhere. It's quoted on every financial news channel, splashed across the headlines of every quarterly report, and it's the first thing most people look for when they analyze a stock. This number is called net income, or, more seductively, earnings per share. It is presented to the world as the final word, the ultimate measure of a company's success or failure, the bottom line. And it is, without a doubt, the most dangerous financial illusion ever created. It's an accountant's opinion, not a fact. It's a story, not a result. For decades, the investing public, from the most seasoned hedge fund managers to the ambitious retail investor just starting their journey towards financial freedom, has been hypnotized by this number. They buy stocks when it goes up and sell them in a panic when it goes down. They build entire investment strategies around predicting its next move. Yet they consistently find themselves trapped, holding shares in companies that report record profits but whose stock prices go absolutely nowhere. Or worse, collapse into dust. Why? Because they are tracking a shadow on the wall, not the object casting it. They are admiring the paint job on a car that has no engine. Warren Buffett in his early days saw this trap. He saw his own teachers and mentors, brilliant men who followed the gospel of net income, get crushed by the market's brutal realities. He realized that the accounting rules designed to create a standardized picture of a business had, in fact, created a funhouse mirror, one that could be bent and warped by clever management to show whatever picture they wanted the public to see. He needed a way to see the truth. He needed a number that couldn't be faked, a number that represented the cold, hard cash a business owner could pull from the enterprise at the end of the year without damaging its long-term prospects. After years of studying thousands of businesses, from struggling textile mills to dominant media giants, he created it. He called it owner earnings. It's not a number you'll find on any standard financial statement. You have to calculate it yourself, and in doing so, you pull back the curtain on the entire financial industry. You begin to see what Buffett sees, that the vast majority of companies are not nearly as profitable as they claim, while a small handful of ignored, unloved businesses are secretly gushing cash. Learning how to perform this one simple calculation is the first and most critical step in transforming yourself from a market participant into a market master. It is the key to unlocking a hidden universe of undervalued stocks and the foundation for building true, lasting wealth. This is not just another stock-picking trick. This is the fundamental shift in perspective that separates the 99% of investors who follow the crowd from the 1% who quietly and consistently beat the market. Chapter 1: The Illusion of Net Income: Deconstructing the Accountant's Lie. Before we can understand the genius of Warren Buffett's solution, we must first become intimately familiar with the problem. We must understand the profound and dangerous flaws baked into the very concept of net income. To do this, we must travel back to the late 1990s, a time of irrational exuberance, a time when a new class of corporate titans was celebrated on the cover of every magazine. And few were celebrated more than Chainsaw Al Dunlap. In 1996, Dunlap was brought in to save the struggling appliance manufacturer Sunbeam. He was a celebrity CEO, a corporate turnaround artist with a brutal reputation for firing thousands of employees and slashing costs to the bone, all in the service of one thing: boosting that magic number, earnings per share. And for a while it seemed to work miracles. Wall Street fell in love. Analysts praised his genius. Sunbeam's stock price soared from around $12 to over $50 a share in less than 2 years. The net income figures were breathtaking. In 1997, Sunbeam reported a stunning $189 million in profit. The company looked like a juggernaut, a testament to Dunlap's ruthless efficiency. Individual investors, the retail investor class looking for portfolio growth, piled in, convinced they were riding a rocket ship to financial freedom. But inside the company, a very different story was unfolding, a story that wasn't visible on the income statement. Dunlap's strategy was not one of genuine business improvement. It was a masterclass in aggressive and ultimately fraudulent accounting. The spectacular net income was a mirage. How was it created? Through a technique known as channel stuffing. Sunbeam offered its retailers, like Walmart and Kmart, massive discounts to buy far more product than they could possibly sell, sometimes 6 months or a year's worth of inventory. These weren't real sales reflecting customer demand. They were just a way to move product from Sunbeam's warehouse to a retailer's warehouse and book the revenue immediately. On the income statement, it looked like a massive sales boom, leading to spectacular net income. But the cash wasn't really there. The retailers would pay later, and in many cases, they had side agreements allowing them to return the unsold goods. Another trick was the bill and hold strategy. Sunbeam would sell grills to a distributor in the middle of winter, booking the profit instantly, but agree to store the grills in its own warehouse until spring. It was a phantom sale. The profit was an illusion. The cost side of the equation was just as distorted. The company recorded expenses from its massive restructuring in special, one-time charge accounts, making its core, ongoing operations look far more profitable than they actually were. The most crucial deception, however, lay in the concept of depreciation. Every company has assets, factories, machinery, trucks. These assets wear out over time. Accounting rules allow companies to take a non-cash charge called depreciation each year to represent this decay. This charge reduces net income but doesn't cost the company any actual cash in that moment. Sunbeam, under Dunlap, likely used the most favorable depreciation schedules possible, minimizing this expense to make earnings look better today, while pushing the true cost of maintaining its industrial base into the future. The result of all this financial engineering was a beautiful income statement and a horrifying cash flow statement. While they were reporting hundreds of millions in profit, the business was actually bleeding cash. It couldn't pay its bills. It couldn't fund its operations. It couldn't invest in new products. It was a financial house of cards. The reckoning came in 1998. The retailers, stuffed to the gills with unsold inventory, stopped ordering. The bill and hold products were never shipped. The house of cards collapsed. The company had to announce that its previous earnings reports were, in essence, a work of fiction. The stock, once the darling of Wall Street, cratered, falling from over $50 to less than $1. Thousands of investors who had put their faith in the net income figure were wiped out. Al Dunlap was fired, and the SEC charged him and other top executives with massive accounting fraud. Sunbeam eventually filed for bankruptcy. The story of Sunbeam is an extreme example, but the psychological principles that trapped its investors are at play in the market every single day. The core issue is a powerful cognitive bias known as anchoring. The human brain is lazy. When presented with a complex problem like valuing a business, it desperately seeks a shortcut, an anchor point to latch onto. Net income and its cousin, earnings per share or EPS, are presented as that perfect anchor. It's a single, clean number. The financial media blasts it out every quarter. XYZ Corp reports earnings of $1.50 per share, beating estimates of $1.45. We hear this, and our brain anchors to it. That number becomes our reality, the benchmark against which we measure success. We stop digging because the anchor feels so secure. This is compounded by another insidious bias, the halo effect. The halo effect is our tendency to let one positive trait about a person or thing color our judgment of all their other traits. When a company reports beautiful, growing net income, a halo forms around it. We subconsciously assume that if its earnings are good, then its management must be brilliant, its products must be superior, and its future must be bright. This halo blinds us to the underlying reality. We don't bother to check the cash flow statement. We don't read the footnotes in the annual report. We don't question the quality of those earnings. The glowing net income figure creates a powerful narrative of success, and we fall in love with the story. ignoring the inconvenient facts. This is precisely what happened with Sunbeam investors. The anchor of record-breaking EPS and the halo of Al Dunlap's celebrity CEO status created a collective delusion that the company was a brilliant investment, even as it was secretly running out of oxygen. This psychological trap is not a bug in the system. For many, it is the system. A CEO's compensation is often tied directly to earnings per share and stock price performance. This creates a massive incentive to manage net income, to make it as smooth and predictable as possible, even if it means sacrificing the long-term health of the business for a short-term boost in reported profits. This is the path of the 99%. So how can we, as individual investors striving for a better financial analysis, protect ourselves from this illusion? The blueprint is to become a financial skeptic, a detective who treats every income statement not as a fact, but as a claim that needs to be verified. The first step in this applied mental model is to always, without exception, compare net income to cash flow from operations. You can find both of these on any major financial website, or even better, in the company's official 10-K filing with the SEC. Net income is on the income statement. Cash flow from operations is the first major section of the cash flow statement. If, over a period of several years, a company's reported net income is consistently and significantly higher than its cash flow from operations, a massive red flag should go up. This is a sign that the company's profits are not translating into actual cash. The earnings are low quality. Why might this happen? You have to dig deeper. Look at the components of the cash flow statement. Is the company's accounts receivable, the money its customers owe it, ballooning faster than its sales? This could be a sign of channel stuffing, just like at Sunbeam. Is its inventory piling up? This could mean the company is producing goods nobody wants to buy, yet it hasn't written them off as a loss. The second step is to read the footnotes of the 10-K report. This is where the company discloses its accounting policies. Are they using aggressive revenue recognition policies? Are they changing how they calculate things from one year to the next? This is where the bodies are buried, and while it can seem intimidating, you are looking for changes and inconsistencies. The third step is to develop a CEO mindset, even as a retail investor. Ask yourself, if I owned this entire business, what would I care about? Would I care about an accounting number, or would I care about the amount of cash I could put in my pocket at the end of the year? The answer is obvious. You would care about the cash. By forcing yourself to think like an owner, not a speculator, you automatically begin to prioritize the right metrics. The path of the 99% is the exact opposite. The average investor operates in a world of headlines and hype. They log into their brokerage account and see a list of top movers. They see a stock that is up 20% on the day because of a, quote, strong earnings report. The fear of missing out, another powerful cognitive bias, kicks in. They don't download the 10K. They don't compare net income to cash flow. They see a green number in a positive headline, and they buy. They are reacting to the story, the narrative spun by the company and amplified by the media. They are participating in a grand illusion, mistaking the symptom, a rising stock price, for the cause, which should be a healthy, cash-generating underlying business. During the dot-com bubble, this mentality reached its zenith. Investors weren't even demanding net income. They were buying companies with massive losses based on metrics like eyeballs or clicks. They believed in a new paradigm, where old rules of finance no longer applied. The end result was the destruction of over $5 trillion in market value, a devastating blow to a generation of investors who had put their faith in narratives instead of numbers. The direct financial connection here is stark and brutal. Let's imagine two companies, both in the business of manufacturing widgets. Company A, let's call it Aggressive Accounting Inc., reports a shiny $100 million in net income. Wall Street loves it. Its stock trades at a high multiple, say 20 times earnings, giving it a market capitalization of $2 billion. But when you look at its cash flow statement, you discover it actually had a negative cash flow from operations of $50 million. To fund its day-to-day business, it had to borrow money or sell more stock, diluting its existing shareholders. This company is a wealth-destroying machine masquerading as a profitable enterprise. Now consider Company B, Boring But Solid LLC. It reports a more modest $50 million in net income. The market is less excited. It trades at only 10 times earnings for a market cap of $500 million. But its cash flow from operations is a robust $80 million. This company is a geyser of cash. It can fund its own growth, pay down debt, buy back its own stock, or pay a dividend to its owners. It is a true wealth creation machine. The investor who anchors on net income buys Company A and feels brilliant for a quarter or two, until the inevitable collapse. The investor who understands the illusion buys Company B, perhaps watches it do very little for a while, and then, over 5 or 10 years, reaps the massive rewards of capital gains as the market slowly and begrudgingly recognizes the power of its cash-generating reality. The first path leads to speculation and potential ruin. The second path, the path of fundamental analysis, is the bedrock of any successful long-term investment strategy. It begins and ends with rejecting the beautiful lie of net income and starting the search for the much more powerful and profitable truth. Chapter 2: The Genesis of Owner Earnings, Buffett's Search for Truth. The journey that led Warren Buffett to codify the concept of owner earnings was not a sudden flash of insight in a university classroom. It was a long, arduous process forged in the crucible of real-world business and investing, born from the failures of his predecessors and the deep-seated flaws he observed in traditional financial analysis. The foundational anecdote, the moment where this philosophy crystallized into a repeatable, powerful tool, can be traced back to 1972 with the acquisition of a humble West Coast candy company, See's Candies. On the surface, See's was the exact opposite of what most investors on Wall Street were looking for at the time. This was the era of the Nifty 50, a group of high-growth blue-chip stocks like IBM, Xerox, and Coca-Cola that were considered so good you could buy them at any price. The mantra was growth, innovation, and technological disruption. See's Candies was none of those things. It was a mature, family-owned business that made boxed chocolates. Its growth was slow and predictable. It was, in a word, boring. Buffett and his partner, Charlie Munger, were introduced to the company by a friend. At the time, Berkshire Hathaway was still primarily a struggling textile business, but Buffett was using the cash it generated to buy better businesses. The asking price for See's was $30 million. The company was earning about $4 million pre-tax and about $2 million after tax. By the standard Wall Street metric of the time, the price-to-earnings ratio, they were being asked to pay 15 times net income. For a slow-growth candy company, this seemed expensive to many, including Buffett at first. He initially countered with a lower offer, and the deal almost fell through. It was Charlie Munger who pushed him, famously telling him to stop being so cheap and to recognize that quality businesses were worth paying for. But what did they see that others didn't? They weren't focused on the $2 million net income figure. They were focused on a different set of questions, questions that get to the heart of the owner earnings mindset. They asked, how much capital, how much cash does this business need to invest each year just to maintain its current level of sales? How much does it cost to keep the candy kitchens running, to replace the old delivery trucks, to keep the storefronts looking fresh? And then they asked the killer question, how much cash does it generate after those necessary maintenance expenses? When they did this analysis, they discovered something incredible. See's Candies was a cash machine unlike almost any other. The brand, built over decades of quality and customer loyalty, was a massive, unrecorded asset on the balance sheet. This brand loyalty meant they could raise prices every year to cover inflation, and customers would happily pay it. Furthermore, the business required very little in the way of new capital investment to grow. To open a new store required a relatively small outlay, and the core manufacturing facilities were already in place. The reported net income of $2 million was significantly understated because it included a non-cash depreciation charge on assets that weren't really declining in value at the same rate. More importantly, the actual cash the business produced, the money an owner could take home, was far, far higher than that $2 million figure. They ultimately paid $25 million for See's. That investment has since become one of the cornerstones of the Berkshire Hathaway empire. In the years that followed, See's sent over $2 billion in cash up to Berkshire's headquarters. That is not a typo. An initial $25 million investment generated $2 billion in distributable cash. This cash didn't need to be reinvested into the candy business. It was free and clear to be deployed elsewhere, to buy other wonderful businesses like Coca-Cola or the Washington Post. See's Candies became Buffett's real-world laboratory for his developing theory of owner earnings. It taught him that the true value of a business is not its reported profit, but its capacity to generate cash over time for its owners. It was the ultimate demonstration that a boring business with a powerful competitive advantage, what he would later call a moat, could be infinitely more valuable than a fast-growing, exciting business that consumed every dollar of cash it generated just to stay in the race. The psychological principle at the heart of this discovery is Buffett's masterful ability to invert common thinking and thereby sidestep powerful cognitive biases that trap other investors. The primary bias at play here is the scarcity heuristic. Our brains are wired to believe that things that are scarce, rare, and difficult to obtain are more valuable. In the 1970s, growth was seen as the scarce and valuable commodity. Investors were terrified of missing out on the next Xerox, the next big thing. This fear drove them to pay astronomical prices for any company that promised rapid expansion. Buffett completely rejected this. He wasn't looking for what was scarce. He was looking for what was durable and predictable. He inverted the problem. Instead of asking, what is the most exciting growth story in the market, he asked, what is a business so simple and powerful that I can confidently predict what it will look like in 10 or 20 years? This led him to candy, newspapers, and insurance, industries that Wall Street viewed as yesterday's news. He also demonstrated a powerful immunity to confirmation bias. Confirmation bias is our tendency to seek out and favor information that confirms our existing beliefs. If an investor believes that tech stocks are the future, they will read articles about tech stocks, talk to other tech investors, and interpret any news through a pro-tech lens. They build an echo chamber around their own thesis. Buffett's approach is the opposite. He actively seeks to disprove his own ideas. He and Munger have a famous saying, "I never allow myself to have an opinion on anything that I don't know the other side's argument better than they do." When analyzing See's, he wasn't just looking for reasons to buy it. He was actively trying to find reasons I don't to buy it. Could a competitor easily replicate their brand? Could consumer tastes change overnight? By rigorously attacking his own thesis from every angle, he builds a much more robust and realistic picture of the business. This intellectual honesty is a hallmark of his success and a core component of the value investing philosophy. So how can we translate this into an applied mental model, a blueprint for our own investment strategy? It starts with defining what Buffett calls your circle of competence. Step 1 is to sit down with a piece of paper and be brutally honest with yourself. What industries or businesses do you genuinely understand? Not on a superficial level, but deeply. Do you understand how they make money, what their competitive landscape looks like, what the key variables are for their success? For most of us, this list will be very small. That's not a weakness, it's a strength. Your goal is not to have an opinion on every stock in the market. Your goal is to find a handful of exceptional companies within your small circle of understanding. Step 2 is to hunt for businesses within that circle that have a durable competitive advantage, or a moat. A moat is something that protects a company from competition, allowing it to earn high returns on capital for a long period of time. It could be a powerful brand like See's or Coca-Cola, a patent like a pharmaceutical company, a network effect like American Express, or a low-cost advantage like Geico. Your job as a financial analyst is to identify the presence and durability of that moat. Step 3, and this is where the owner earnings mindset truly comes in, is to focus on the economics of the business, not the stock market's opinion of it. Ignore the daily price fluctuations. Instead, pretend you are going to buy the entire company and own it for the next 30 years. With that frame of mind, what would you pay for it? The answer has to be based on the future cash you expect it to generate for you, its future owner earnings. This simple shift in perspective, from stock renter to business owner, is the most powerful mental model in all of finance. It forces you to think about the long-term fundamentals and immunizes you from the short-term noise and speculative frenzy of the market. It is the core of Buffett's CEO mindset. The antithesis of this approach, the path of the 99%, was perfectly embodied by the Nifty 50 mania of the early 1970s. These were, by all accounts, wonderful companies. They were the dominant players in their industries. But investors, caught in a frenzy of growth chasing, forgot a crucial component of the value equation: price. They became convinced that these companies were so good that no price was too high to pay. They bought Polaroid at over 90 times earnings. They bought Avon at over 60 times earnings. They completely disregarded any disciplined analysis of the cash these businesses could be expected to generate relative to the price they were paying. They were buying the story, not the business. The inevitable crash came in 1973 and 1974. The market plunged, and these high-flying stocks fell by 50, 60, even 90%. It didn't matter that they were still great companies. The initial price paid was so astronomically high that it guaranteed horrible returns for the investors who bought at the peak. This is the ultimate danger of ignoring the owner's perspective. You become untethered from reality, floating on a cloud of narrative and sentiment. And the fall back to earth is always brutal. The direct financial connection of the See's Candy story is the most powerful illustration of compounding wealth imaginable. That initial $25 million purchase price was based on a sober analysis of the company's ability to generate cash for its owners. The subsequent $2 billion in dividends that See's paid to Berkshire Hathaway is the tangible result of that analysis. Let's break that down. This isn't just stock price appreciation, which can be fickle. This is cold, hard cash, moved from the bank account of the operating business to the bank account of the parent company, where it could be used for other wealth-creating activities. This is the ultimate goal of any investment. An asset that appreciates in value but never generates distributable cash is ultimately just a speculation. An asset that gushes cash year after year with little need for reinvestment is the holy grail of wealth management. It is the engine of financial freedom. The owner earnings from See's funded Berkshire's purchases of other companies, which in turn generated their own owner earnings, creating a virtuous cycle of compounding that has built one of the largest and most successful companies in the world. It all started with a simple, profound insight. Look past the accountant's net income and find the true, cash-generating heart of the business. That is the secret that See's Candy's revealed, and it's a secret that can fundamentally change how you analyze stocks and build your own portfolio for long-term success. Chapter 3: The Anatomy of the Calculation, your toolkit for financial X-ray vision. Armed with the understanding of why net income is flawed and the philosophical underpinning of why cash is king, it is time to move from the conceptual to the concrete. It is time to build the tool itself. The owner earnings calculation is Buffett's scalpel, the instrument he uses to dissect a business and separate the fat of accounting distortions from the muscle of true cash generation. And like any powerful tool, it requires precision and a clear understanding of its components. The perfect story to illustrate this process in action is not one of a small, private candy company, but of a massive, public, and vital American institution, the Washington Post. In the mid-1970s, the American stock market was in a state of crisis. The aftermath of the Nifty 50 collapse and a brutal economic recession had created a climate of extreme pessimism. Stocks were universally loathed. The Washington Post Company, despite its dominant position in the nation's capital and its recent journalistic triumphs with the Watergate scandal, was not immune. Its stock price had been hammered, falling to a point where the entire company was valued by the market at a mere $80 million. Most investors saw a struggling newspaper and a declining industry and ran for the hills. Buffett saw something entirely different. He saw a media monopoly, a fortress with an unbreachable moat, trading at a ridiculously cheap price. But to confirm his intuition, he had to do the work. He had to look past the reported net income and calculate the true owner earnings of the business. Let's walk through a hypothetical version of the analysis he would have performed, using the exact formula he laid out in his 1986 letter to shareholders. The formula is elegantly simple. Owner earnings equals a company's net income plus depreciation, depletion, and amortization, minus the amount of capital expenditures that are essential to maintain its long-term competitive position and unit volume. That last part is the secret sauce, but let's build it piece by piece. First, Buffett would have started with the Washington Post's reported net income. In 1973, this was around $10 million. To the average analyst, a company earning $10 million with a market price of $80 million was trading for 8 times earnings. In a bear market, that might have seemed reasonable, but not a screaming bargain. But Buffett knew this was just the starting point. The next step is to add back depreciation. Depreciation is an accountant's guess about how much a company's assets have worn out in a given year. For a newspaper, this would be the depreciation on their massive printing presses, their delivery trucks, and their buildings. It's a non-cash charge. The company doesn't actually write a check for depreciation. It's an expense on the income statement that reduces reported profits, but it doesn't reduce the cash in the bank. So to get closer to a cash-based reality, we must add it back. Let's say, hypothetically, the Washington Post had a depreciation charge of $7 million that year. By adding that back to the $10 million in net income, we now have a figure of $17 million. This is a rough proxy for the cash the business generated before any new investments. Now comes the crucial and most difficult third step, subtracting the cost of staying in business, what Buffett calls maintenance capital expenditures or maintenance CapEx. A business can't simply stop investing in itself. The old printing presses do eventually need to be replaced. The delivery trucks wear out. The buildings need new roofs. A certain amount of cash must be spent each year just to keep the business running at its current level, to stand still. This is a real cash expense, and it must be subtracted. Here is where Buffett's genius as a business analyst, not just a stock picker, comes into play. The company's financial statements don't break out capital expenditures into maintenance and growth. They just report one number for all capital spending. It's up to the analyst to estimate the maintenance portion. How would he have done it for the Post? He would have studied the newspaper industry. He would have known roughly how long a printing press lasts and what it costs to replace. He might have looked at the company's capital spending in years when it wasn't expanding its circulation, using that as a baseline. Let's imagine his deep analysis led him to conclude that the Washington Post needed to spend about $4 million a year, on average, just to maintain its existing operations. Now we can complete the calculation. We take the $17 million, net income plus depreciation, and subtract our estimated $4 million in maintenance CapEx. The result is $13 million. This is the owner earnings. This is the real profit of the business, the cash that an owner could pocket without harming the enterprise, and the difference is staggering. The market saw a company earning $10 million and valued it at $80 million. Buffett, through his owner earnings lens, saw a company earning $13 million in real, spendable cash. That's 30% more in profit than was being reported. This meant the real valuation was not 8 times earnings, but closer to 6 times owner earnings. And he knew that because of its dominant moat, these earnings were highly likely to grow in the future. He concluded that the business was worth at least $400 million, maybe more. Buying it at $80 million offered him an immense margin of safety. Berkshire Hathaway invested aggressively. And that investment became one of its most successful of all time, compounding at a staggering rate for decades. The psychological principle that this calculation helps an investor overcome is called complexity bias. Our brains have a tendency to believe that a complex solution is better than a simple one. Wall Street is a temple to this bias. It is filled with analysts building extraordinarily complex discounted cash flow models, with dozens of variables projected out for decades, all to arrive at a precise but ultimately useless estimate of a stock's value. These models create an illusion of scientific rigor, but as the saying goes, garbage in, garbage out. A tiny change in the assumed long-term growth rate or discount rate can wildly swing the final valuation. Buffett's owner earnings formula is a rebellion against this false complexity. It is brutally simple. It focuses on the one or two key variables that truly matter: the cash a business generates and the cash it must spend to stay in business. It's about getting a figure that is approximately right rather than precisely wrong. By forcing yourself to use this simpler, more robust framework, you avoid the trap of overanalysis and the false comfort of intricate but flawed models. It is a tool for clear thinking in a world that profits from confusion. So, let's build the blueprint. How can you, a retail investor, perform this calculation today on any public company? It's easier than you think. Step 1. Go to the SEC's EDGAR database or the Investor Relations section of the company's website and download their latest annual report, the 10K. This is the primary source document. Don't rely on third-party data if you can avoid it. Step 2. Open the report and find the Consolidated Statements of Earnings or income statement. At the very bottom, you will find the net income line. Write that number down. Step 3. Navigate to the Consolidated Statements of Cash Flows. The very first line in the Cash Flows from Operating Activities section will be net income, confirming you have the right number. A few lines below that, you will see a line item called Depreciation and Amortization. Add this number to your net income. Step 4. This is the artistic part of the process, estimating maintenance CapEx. Stay in the cash flow statement and scroll down to the Cash Flows from Investing Activities section. Here you will find a line, usually a negative number, called Purchases of Property, Plant, and Equipment, or something similar. This is the company's total capital expenditure, CapEx, for the year. The challenge is that this number includes both maintenance spending and growth spending. You must separate them. Here are a few practical methods. Method A, the simple baseline. For a mature company with little to no growth, maintenance CapEx will be roughly equal to the depreciation charge. So as a conservative first estimate, you can simply use the full depreciation figure as your maintenance CapEx. Method B, the Greenwald method, named after the famous value investing professor Bruce Greenwald. This is more involved. You calculate the company's property, plant, and equipment, PP&E, as a percentage of sales for a period of years. Then you see how much sales grew in the most recent year. You multiply the historical PP&E to sales ratio by the sales growth to estimate the portion of CapEx that was for growth. Whatever is left over from total CapEx is your maintenance figure. Method C, the simplest and often most effective. Read the Management Discussion and Analysis, MD&A, section of the 10K. Sometimes, management will actually discuss their capital spending plans and give you clues as to how much is for maintenance versus expansion. Step 5. Once you have your best estimate for maintenance CapEx, subtract it from the number you got in Step 3, net income plus depreciation. The result is your owner earnings. You have now created the single most important number for valuing a business. The antithesis to this deep, fundamental analysis is the world of the day trader, or the pure technical analyst. Their universe is not the 10K report, it is the stock chart. They are not concerned with depreciation schedules or capital expenditure policies. They are focused on moving averages, trading volumes, and chart patterns like head and shoulders or cup and handle. They believe that all known information about a company is already reflected in its stock price, and that the future direction of the price can be predicted by analyzing its past movements. This is a world entirely divorced from the underlying reality of the business. For a technical trader, a stock is not a piece of a business. It is a symbol on a screen, a blip that they hope to buy and sell for a quick profit. While some may find success in this arena, for most it is a path to high transaction costs, emotional decision-making, and, ultimately, poor returns. It is speculation, not investing. It is the financial equivalent of trying to figure out a person's weight by measuring their shadow. The owner-earnings investor, by contrast, is ignoring the shadow and putting the business itself on the scale. The direct financial connection of mastering this calculation is that it gives you a permanent, structural advantage over the majority of market participants. When a company with heavy capital expenditure reports a good quarter of net income, the market often gets excited and bids the stock up. You, however, will run your owner-earnings calculation and see that despite the reported profit, the company is actually generating very little or even negative cash for its owners. You will wisely avoid the stock, protecting your capital. Conversely, when a wonderful capital-light business has a temporary dip in reported net income due to a one-time charge or an accounting change, the market may panic and sell the stock off. You will run your calculation and see that the underlying owner-earnings power of the business is still immense and growing. This gives you the confidence to buy when others are fearful, which is the single greatest source of market-beating returns. Over a lifetime of investing, making your decisions based on owner earnings rather than net income will result in a portfolio filled with higher quality, more resilient, and ultimately more profitable businesses. It is the one financial analysis tool that can truly serve as the foundation for a successful wealth management strategy, leading to superior capital gains and genuine financial freedom. Chapter 4: The Capital Expenditure Conundrum: Separating Growth from Survival. We have established that the most critical and most challenging part of the owner-earnings calculation is the final step: subtracting maintenance capital expenditures. This single line item is the pivot point upon which the entire analysis turns. Getting it right, or even approximately right, is what separates a superficial analysis from a truly insightful one. It is the moment where the investor must transform into a genuine business analyst. The distinction between the two types of capital spending, money spent simply to maintain the status quo versus money spent to expand and grow, is perhaps the single most important concept in all of corporate finance, yet it is almost universally ignored by the average investor. To truly grasp its power, we must examine two very different businesses that exist within Warren Buffett's own empire, the BNSF Railway and American Express. These two companies provide a perfect, stark contrast between a capital-intensive beast and a capital-light marvel. First, consider BNSF, the massive freight railroad that Berkshire Hathaway acquired in 2009. A railroad is the quintessential capital-intensive business. It owns vast amounts of physical stuff, over 32,000 miles of track, thousands of locomotives, tens of thousands of freight cars, bridges, tunnels, and signaling systems. This stuff, its property, plant, and equipment, is the heart of the business, but it is a heart that is constantly under assault, from wear and tear, from weather, from the relentless stress of carrying billions of tons of cargo across the country. Every single year, BNSF must spend a staggering amount of money just to tread water. It must replace worn-out sections of track, rebuild locomotive engines, and repair bridges. This is maintenance CapEx, and it is a non-negotiable cost of doing business. In a typical year, BNSF might spend over $4 billion on total capital expenditures. A huge chunk of that, perhaps $3 billion or more, is purely for maintenance. It doesn't add a single mile of new track or increase the company's overall capacity. It is the enormous cost of survival. So when BNSF reports, say, $6 billion in net income and has $2 billion in depreciation, the naive analyst might think the business is generating $8 billion in pre-capex cash. But after subtracting the $3 billion in maintenance spending, the true owner earnings are closer to $5 billion. Still a fantastic business, but the sheer gravitational pull of its maintenance capital needs is immense. Now contrast this with American Express. What are the primary assets of American Express? It's not a factory or a railroad. Its primary asset is its brand, a globally recognized symbol of trust, prestige, and financial security. Its other key asset is its network, the closed loop connecting millions of high-spending cardholders with millions of merchants who accept the card. These assets are incredibly valuable, but they are largely intangible. They don't appear on the balance sheet for what they're truly worth. And more importantly, they require very little in the way of physical maintenance capital. American Express has office buildings and computer servers, of course, and those require some spending to maintain and upgrade. But this amount is utterly trivial compared to the scale of the business and the profits it generates. When American Express spends money, it's typically on things like marketing or technology development. This is almost entirely growth CapEx, designed to acquire new customers and expand the network's capabilities. The business is a capital-light marvel. Almost every dollar of profit, after adding back its small depreciation charge, converts directly into owner earnings. It gushes cash that can be returned to shareholders through massive stock buybacks and dividends, without starving the business of the funds it needs to operate. Buffett's investment in American Express has been so successful not just because it's a great brand, but because it is a business that doesn't consume its own profits just to stay alive. The deep psychological reason most investors and even professional analysts fail to make this crucial distinction is a phenomenon known as the Semmelweis reflex. Named after a 19th-century Hungarian physician who discovered that hand-washing could prevent fatal infections in hospitals, the reflex describes the automatic tendency to reject new evidence or new ideas because they contradict established beliefs and norms. Ignaz Semmelweis presented overwhelming evidence for his theory, but the established medical community rejected it out of hand because it implicitly suggested that they, the doctors, were the ones causing the deaths. The idea was too disruptive to their worldview. In finance, the established norm is to view all capital expenditure as investment. It's a positive word. A company spending billions on investing for the future sounds proactive and smart. The Buffett insight, which is a contrarian and disruptive idea, is that a large portion of that investment is not for the future at all. It is a treadmill, a tax on the business for simply existing. It is the cost of running to stand still. Admitting this forces an analyst to confront the uncomfortable truth that many highly respected, large-scale industrial companies are not nearly as profitable in a true economic sense as they appear. It's easier and more comfortable to stick with the established belief and lump all CapEx together as a good thing. Overcoming the Semmelweis reflex requires the intellectual courage to challenge convention and accept a potentially uncomfortable reality. So how can we, as retail investors, build a practical blueprint to better estimate this crucial number? We need a toolkit of different methods, as no single approach works for every company. Method 1, as we touched on, is using depreciation as a baseline. In a steady-state business that isn't growing, the amount of capital it needs to spend to replace its wearing-out assets should, over a long period, be roughly equal to its depreciation charge. Therefore, for mature, slow-growing companies, using depreciation as your proxy for maintenance CapEx is a very reasonable and conservative starting point. If total CapEx is significantly higher than depreciation, it's a good sign that the excess is being used for growth initiatives. Method 2 is the percent of sales approach. This requires a bit more historical data, which you can find in services like Morningstar, or by looking at the last 10 years of annual reports. You create a simple spreadsheet. For each of the last 10 years, you list the company's total revenue and its total capital expenditures. Then, you calculate CapEx as a percentage of sales for each year. Now look for trends. Were there years when the company's revenue was flat or declined? In those years of no growth, what was the CapEx to sales percentage? This figure gives you a good baseline for the company's maintenance needs. You can then apply this historical maintenance percentage to the current year's sales to estimate the current year's maintenance CapEx. Method 3 is the most detailed and requires the most business acumen, the per-unit analysis. This is about breaking down the business into its fundamental operating units. For BNSF, you might ask, how much does it cost to maintain 1 mile of track per year? You could then multiply that by the total miles of track to get a rough estimate. For a retail company, you might ask, what is the average cost to refurbish an existing store? For an oil company, what is the cost to maintain production at an existing well? This approach requires a deeper dive into the company's investor presentations and industry reports, but it can yield the most accurate results because it's grounded in the physical reality of the business operations. It's the closest you can get to thinking like the actual CEO running the company. The antithesis, the path of the 99%, is perfectly illustrated by the historical performance of the airline industry. For decades, Warren Buffett famously detested airlines as an investment, calling them a death trap for investors. Why? On the surface, during good economic times, airlines can report very high net income. They fly millions of passengers, generate billions in revenue, and the bottom line profit can look very appealing. But the industry suffers from a truly brutal capital expenditure reality. An airplane is an astronomically expensive, rapidly depreciating asset. And to remain competitive, an airline must constantly spend enormous sums of money on new, more fuel-efficient planes. This is not optional. If your competitors have new planes that cost less to fly, you must match them, or you will be driven out of business. This constant, massive fleet replacement is a form of maintenance capex on a gargantuan scale. The result is that even in years of high reported net income, the airlines were often burning cash. The money never made it to the owners. It was immediately consumed by the need to buy the next generation of aircraft. Investors who were seduced by the net income figures in the good years were repeatedly wiped out when a recession hit or fuel prices spiked, as these cash-poor businesses had no financial cushion and quickly spiraled towards bankruptcy. They were the ultimate capital-intensive trap. The direct financial connection of mastering this analysis is profound, and it directly impacts your asset allocation and long-term portfolio growth. Let's model out two hypothetical companies over 10 years. Company A is Capital Light Software Inc., and Company B is Capital Intensive Manufacturing Corp. Both start with $100 million in revenue. Both are fantastically well run and manage to grow their revenue by 15% per year for 10 years, ending with over $400 million in revenue. The net income margins for both are a healthy 20%. On the surface, they look like equally great investments. But now let's look at their capital needs. Capital Light Software's total CapEx is only 5% of its revenue. Capital-intensive manufacturing's total CapEx is a heavy 25% of its revenue. And for the manufacturing company, 80% of that spending is just maintenance to keep the factories running. When you run the owner earnings calculation for both companies, year after year for a decade, the difference is breathtaking. Over the 10-year period, the software company will have generated a cumulative total of over $500 million in owner earnings, cash that could be returned to shareholders. The manufacturing company, despite having the exact same revenue growth and net income margins, will have generated less than $100 million in cumulative owner earnings. The vast majority of its profit was consumed by the machine. As an investor, which stream of cash would you rather own? The choice is obvious. By learning to differentiate between good growth, which adds to owner earnings, and bad growth, which consumes it, you can steer your portfolio towards businesses that are genuine wealth creators, dramatically increasing your chances of achieving superior capital gains and true, lasting financial freedom. Chapter 5. The Owner Earnings Mindset in Action, Beyond Stocks to Life and Business. The principle of owner earnings is not merely a formula for stock valuation. To treat it as such is to miss its most profound implication. It is a complete mental model, a philosophy for assessing the economic reality of any system, whether it's a multinational corporation, a small family business, or even your own personal finances. It's a way of thinking that, once adopted, permeates every decision you make. And there is no better living embodiment of this total, all-encompassing mindset than Warren Buffett himself. His personal life is the ultimate foundational anecdote for the owner earnings principle applied to an individual. Here is a man with a net worth approaching $100 billion, yet he famously lives in the same modest house in Omaha, Nebraska, that he bought in 1958 for $31,500. He drives a reasonably priced car, which he buys at a discount and keeps for years. He is famous for his frugal breakfast from McDonald's, often choosing the cheaper option if the market is down that morning. To the outside world, these habits might seem like mere eccentricities, the quirky traits of a folksy billionaire. But they are not. They are the physical manifestation of the owner earnings mindset. Buffett treats his own life as the ultimate business. Warren Buffett, Inc. His income from his salary and investments is the revenue. His living expenses, the cost of his house, his car, his food, are the maintenance capital expenditures. These are the costs required to keep the Warren Buffett Inc. enterprise running. By keeping these maintenance costs extraordinarily low relative to his revenue, he maximizes his personal owner earnings. And what are personal owner earnings? It is the surplus cash available at the end of the year that can be deployed for its highest and best use. For Buffett, that use is investment, the compounding of his capital. Every dollar he doesn't spend on a more expensive house or a fancier car is another dollar soldier sent out into the world to work for him, to generate more soldiers, in a virtuous cycle that has created one of the world's greatest fortunes. He understands on a cellular level that a dollar spent on unnecessary consumption is a dollar that can no longer compound. This is not being cheap. This is a radical form of financial efficiency. He is running his life with the same ruthless logic he applies to evaluating a business like See's Candies or American Express, and the results speak for themselves. The psychological principle that underpins this entire philosophy is the epic battle within our own minds between two different systems of thinking, a concept popularized by the psychologist and Nobel laureate Daniel Kahneman. He describes System 1 as our fast, intuitive, emotional, and automatic thinking. It's the part of our brain that reacts instantly, that wants the new car now, that feels the thrill of a rising stock, that succumbs to impulse. System 2 is our slow, deliberate, logical, and effortful thinking. It's the part of our brain that does math, that weighs long-term consequences, that can override the emotional impulses of System 1. The entire world of consumerism, of quarterly earnings hype, of day trading, is designed to appeal to System 1. It's about instant gratification. The owner earnings mindset, in both business and in life, is a triumph of System 2. It requires you to pause, to override the immediate desire for a bigger reported profit or a flashier lifestyle, and to perform a deliberate, logical calculation. It is the conscious choice to prioritize long-term cash generation over short-term appearances. Achieving financial success, whether as an investor, an entrepreneur, or simply in your personal life, is largely the process of training your System 2 thinking to be the dominant force in your financial decisions. It is the practice of delayed gratification on a grand scale. This powerful mindset can be translated into a practical blueprint, an owner earnings audit, that you can apply to any area of your life. For entrepreneurs and business owners, this is a game changer. Stop obsessing over top-line revenue growth or your accounting net income. Instead, at the end of each quarter, sit down and calculate your business's true owner earnings. Start with your net income, add back depreciation, and then honestly assess how much you had to spend on capital equipment just to keep the business at its current level. The number that's left is your real profit. That is the amount of cash you could, in theory, pull out of the business without harming its long-term health. This number should guide your entire business strategy. How can you increase it? Can you switch to a business model that requires less maintenance capital? Can you extend the life of your existing equipment? This shifts your focus from looking successful to being successful. For the retail investor looking to achieve financial freedom, you must apply this same audit to your personal finances. Your salary is your revenue. Your recurring bills, your rent or mortgage, your car payments, your groceries. These are your operating expenses, but then you have other costs. The money you spend to repair your car, to replace a broken dishwasher, to maintain your home. This is your personal maintenance CapEx. You must spend this money just to keep your life running smoothly. What is left over after all of that? That is your personal owner earnings. That is the surplus capital you have available to invest, to build your portfolio, to work towards a future where your capital gains and investment income can replace your salary. The goal of a sound personal finance strategy is to systematically and relentlessly grow the gap between your income and your all-in expenses, thereby maximizing the personal owner earnings you can deploy into compounding assets. For the aspiring executive or someone with a CEO mindset, this framework should be applied to every major capital allocation decision. When a division manager comes to you with a proposal for a new project that requires a $10 million investment, you must view it through the owner earnings lens. Don't be seduced by projections of how it will boost revenues or even net income. Ask the hard questions. How much of this investment is just to replace an old system that was going to fail anyway? How much of it is true growth? And most importantly, what is the expected return in future distributable cash in future owner earnings from this investment? This disciplined approach prevents, quote, empire building, where managers expand their departments for the sake of prestige rather than profitability, and ensures that the shareholders' capital is being treated with the respect it deserves. The antithesis of this disciplined, cash-focused mindset is the prevalent growth-at-all-costs culture of the modern venture capital and startup world. For years, companies were celebrated for achieving astronomical revenue growth while burning through billions of dollars in investor capital. The ultimate poster child for this was WeWork. The company had a captivating story, a charismatic founder, and revenue figures that were truly staggering, doubling year after year. The media and private market investors were mesmerized. It was hailed as the future of work. But if anyone had bothered to apply an owner earnings analysis, they would have recoiled in horror. WeWork's business model was fundamentally capital-intensive. They had to sign long-term leases on expensive real estate, spend a fortune renovating it, and then rent it out on a short-term basis. The maintenance capital required to keep their locations looking trendy and fresh was enormous. The business was burning cash at a rate of billions of dollars per year. There was no net income, and the owner earnings were a colossal negative number. The entire enterprise was a financial inferno sustained only by a continuous flood of new venture capital. When the flood of capital stopped and the company tried to go public, its financials were exposed to the harsh light of the public markets, and the entire valuation collapsed in one of the most spectacular corporate implosions in recent history. It was a multi-billion-dollar lesson in the fatal danger of prioritizing a growth narrative over cash flow reality. The direct financial connection that ties all of this together is simple but profound. A portfolio constructed with a bias towards companies that exhibit strong and growing owner earnings will, over the long term, almost inevitably outperform a portfolio built on the shaky foundation of reported net income. Why? Because companies with high owner earnings have options. They are masters of their own destiny. They can choose to reinvest in high-return growth projects. They can acquire other businesses. They can pay down debt. They can pay dividends, or they can buy back their own stock, a move that is particularly powerful when the stock is undervalued. Companies with low or negative owner earnings, no matter how high their reported profits, have no options. They are slaves to the capital markets. They must constantly raise money by borrowing from banks or selling more stock, which dilutes existing shareholders. This creates a constant headwind against long-term stock price appreciation. By making the owner earnings calculation the primary filter in your investment strategy, you are systematically tilting the odds in your favor. You are engaging in a superior form of fundamental analysis, one that leads to better asset allocation, lower portfolio turnover, and a more tax-efficient path towards building real wealth. It is more than just a tool for how to analyze stocks. It is a foundational principle for how to make money, manage that money, and ultimately achieve the financial freedom to live life on your own terms. You have now acquired a powerful piece of intellectual machinery. You have installed into your mind the financial X-ray vision that Warren Buffett developed over a lifetime of intense study and practice. You can now look at the financial statements of any company and see past the seductive and often misleading illusion of net income. You can see through to the bedrock truth of a business, its actual, tangible, cash-generating power. This is not just a formula you have learned. It is a new way of seeing the entire economic landscape, a fundamental shift in your perception of value. You now hold the key to differentiating financial reality from financial fiction. But understanding a company's true cash flow, its owner earnings, is only the first of two critical pillars in the Buffett-Munger system of value investing. This powerful tool tells you if a business is good naba. It tells you if you have found a wonderful wealth-creating enterprise. But it does not tell you if it is available at a times great price. How do you take the owner earnings you can now calculate and translate that into a confident, conservative estimate of what the entire business is actually worth? How do you then compare that intrinsic value to the current stock price to ensure you are buying with what Buffett calls a margin of safety, the built-in cushion that protects you from error, bad luck, or the wild swings of the market? The owner earnings calculation provides the engine of your analysis, but the margin of safety calculation is the steering wheel and the brakes. It is what separates brilliant analysis from profitable investing. The video that is now appearing on your screen is the next essential piece of that map. It is the bridge that connects the identification of a wonderful business with the discipline of knowing the precise moment to invest in it. It takes the owner earnings number you have just mastered and shows you how to convert it into a clear, actionable valuation range. It is the link that connects the question of asterisk what to buy with the all-important question of asterisk when to buy. Many people will stop here, content with the powerful tool they have just acquired. They will be far ahead of the average investor. But those who are truly committed to achieving financial independence, those who seek to become world-class practitioners of this craft, understand that each mental model in this system is a load-bearing wall. They build upon and reinforce one another. The journey to becoming a truly intelligent investor isn't about finding a single secret. It is about assembling the complete mental arsenal, a network of interlocking principles that create an unbreakable intellectual fortress. Your ascent is not complete. Complete your arsenal. Click the video and install the next critical piece of the system.